Jillian from Earn and Stream, Ivy from Plume, and Felix from Greenfield Capital.
Thanks a lot. Yeah, I mean, maybe we can each say a little bit about our project. I'm Felix from Greenfield Capital. We are investing across crypto, DeFi, consumer infrastructure, and our core thesis is that DeFi can reach its true potential if it can serve the real world. And yeah, hence I'm really excited to moderate this panel.
I'm Jillian. I'm from EarnStream. We're based in the Bahamas, and we're turning wages into liquid, programmable digital assets so that employees could instantly use it and access financial products and credit.
Hey guys, I'm Ivy. I'm on the BD side of Plume. We are an L1 focused on RWAs and focus on the intersection of RWAs and DeFi composability. We're looking to bring on all types of tokenized assets and actually make them usable, interesting, and actually allow crypto users to tap into real-world yield.
Hey guys, I'm John from Superstate. I'm the head of engineering. What we do at Superstate is we basically take private mutual funds with investment mandates, and then we put them on Ethereum as ERC20s. So one of our products is a treasury bill fund. The other is a cash and carry trade, not too different from Athena. And our assets have allow lists, but we put a lot of effort into making sure they're still composable in DeFi.
Yeah, I think generally, us crypto natives, we're talking about onboarding RWAs, while TradFireRunner talks about on-chain finance. I think ultimately it will just be finance, all running on blockchains, with the advantages that encompasses. We have around like 600 trillion assets globally, while crypto is only 3 trillion at the moment, around like 18 billion of tokenized assets, excluding stablecoins, which are 220 billion at the moment. So we have loads of room to grow, and I guess you guys are the ones that are making that happen. And are you rather providing the tech stack that improves an existing value proposition for your user base or an existing tech stack, or are you rather providing a solution that allows users to leapfrog non-existent solutions, for example, in emerging markets?
Yeah, so for EarnStream, we exist in an emerging market that has some specific nuances. One of the big things that we have in the Bahamas is exchange control that's been limiting how much we can access or how much we can use or how much we can benefit from some of the existing tech. But then, of course, there's tech that exists that is already out there, already usable, things like streaming payments that a lot of DAO companies use. And so I think we have a mesh of both, where we use a lot of the protocols that already exist, but we have to innovate some protocols and in one instance totally recreate how we approach some of the tech to be able to fall in line with regulation that's not likely to change right away. So for the tech, yeah, we have some small changes to make it fit the markets. And as we go through the Caribbean, I'm sure there are other nuances that we need to match, and we'll have to change tech for that as well. Yeah.
Yeah, at Plume, I think our goal is really to allow asset issuers all the way from the large Franklin Templetons to the middle market, credit funds, all the way down to smaller issuers, really tap into tokenization without the headache of hiring smart contract engineers. We actually built an in-house product called ARC. This is a tokenization that's free to use for our whole ecosystem, and it deploys smart contracts directly, and it lets asset issuers manage the life cycle of their tokenized assets on Plume. I think on the more ecosystem side, we're really not trying to reinvent the wheel, because I think the beauty of what other ecosystems have built, Arbitrum, Ethereum mainnet, Optimism, is they built really great DeFi composability. And our goal is really to bring in some of these larger protocols, the Pendles, the Spectras, the Aves of the world, to accept these tokenized assets that are coming onto Plume and really be kind of like the breeding ground between the two. So imagine you can take a tokenized credit position or a yield-bearing treasury or some sort of yield-bearing asset that's potentially, one of your assets, and actually make them, let's say, collateral on a permissionless borrow lend market, or allow you to trade the yield portion in a DEX. That's something that we're trying to bridge. So we're not creating all of our products in house, but really trying to bring the hard part on, which is the tokenization part, and allow the benefits of composability and the integration with existing protocols happen.
Yeah, at Superstate there's a lot of similarities with Plume in the sense that we're not really trying to reinvent the wheel, but we're trying to take assets that exist off-chain and make them useful on-chain and be used widely throughout DeFi. So that's it in a nutshell.
Cool. And what kind of asset classes are you seeing most demand for, be it from the issuer side or the supply side or demand side? And is it rather retail or institutional? And what are you guys focusing on specifically?
Yeah, I can take this one. So on Superstate, what we're seeing a lot of demand for so far is especially our treasury bill fund. A lot of stablecoin issuers are starting to use USTB, that's our treasury bill fund, to back their stablecoin and potentially pass some of that yield back to customers. So for example, Frax just launched their new stablecoin FRX USD, and it uses 2 different Superstate assets to back it along with other assets as well.
Yeah, I think treasuries are probably the ones that are going to have the most kind of next product market fit. I think what's interesting is any type of yield product that is in the profile of more liquid. So it could be, pay-fi products where you're financing cross-border payments. Anything that's more liquid, I think, will have kind of the next iteration of traction. What stablecoins did really well was they were actually the original RWA because they're backed by treasuries. But the reason why people don't actually even think that they are RWA is because they kind of transcended that, and they're composable, they're permissionless. Anyone can buy them and purchase them and sell them. So I think as we move down to kind of the scale, it'll probably go from treasuries to money markets, and just go more as the industry matures. You'll start to find credit things of that nature that get more composable and used throughout crypto.
Yeah, and for us, so we're still very, very early stage, so we haven't seen the demand yet. But I mean, what we're banking on is looking at exactly, what we're doing is tokenizing wages. And so the programmability that it brings to the retail market is something that we think is going to be very, very useful for those markets. And then treasury management and things like yield for the institutional markets is what we are looking at, and we think will be beneficial to those markets. Yeah.
Can I throw in a quick wild card? So I think the next asset class that's going to come on chain pretty quickly is tokenized equity. I don't think we're there yet, but I think it's actually going to happen really, really fast.
Yeah, I guess we already see some tokenized ETFs. I mean, I think Mirror, for example, back in the day was a pretty wild success until it was not.
Like a legitimate version.
Yeah, but yeah, definitely. I think that's really cool, and maybe we come to that in the composability part, having large numbers of asset classes, the biggest asset classes on chain, enabling then just automated portfolio management via AMMs. I think that's a really exciting use case, personally. What would you say are the most significant advantages of tokenizing individual assets or funds? I guess the question is a bit where do we also see more traction in the short to mid term? Since I think it's a bit hard for individual investors to track for all the individual assets and kind of invest, for example, into individual loans. But in your mind, or maybe from your use case perspective, what are the most significant advantages?
This is the problem that we're building EarnStream for. We find that in the emerging markets, or in the markets that we are in, employees just can't access credit because they can't access the financial products that are needed to basically for lenders to give them the products. Right now, 40% of employees in the Bahamas have access to credit and financial products. The rest of the workforce is underbanked, and so that's kind of where we see that benefit for tokenized wages. Yeah.
Cool.
Forgot your question halfway, but yeah, we're there.
Yeah, I mean, like you could say like wage, like a tokenized wage is like an individual tokenized asset.
Yeah.
Like I mean, you can basically tokenize all different kinds of, like as physical asset plus financial assets, and
Right.
like a cash flow,
Right.
like a stream
And that
is
cash
definitely
flow is
kind of like
actually
you can
where there's
represent that.
Yeah, that cash flow is where there's a lot of benefit. We did some models based on minimum wage workers, and if a worker, and let me get my stats right, if a worker enters a job with $760 of debt, it would normally take them, and this is absolute minimum wage, which just rose in the Bahamas, and Stefan's gonna have to tell me what it is. I think it's $7.25 an hour now. If they were to enter a new job with $760 in debt, they would be able to pay that off in 8 months. But with the fast accumulation of streaming or that increased cash flow, they're actually able to pay it off in 3.5 months by doing nothing different, just because the cash is accumulating faster, and they can actually allocate it because it's programmable, allocated toward paying off the bill faster.
And maybe also more capital efficiency
Absolutely.
for using like the stream payment, like maybe even in a yield-bearing asset.
Absolutely, and that's without having the yield-bearing side, and that's without calculating extra fees on top of that for late payments. Yeah.
Yeah, I think one thing that we're really excited about at Plume is actually unlocking liquidity for a lot of assets that are very idle, currently sit in walled gardens and don't really have much utility. One good example I think a lot of companies in this space are trying to do is actually tokenize private markets. So you can think of like pre-IPO equity or private positions that are held within funds. What's really great about liquid markets is that they enable price discovery. So imagine you can actually have very, very liquid trading markets that don't use a middleman broker to match buy and sell orders of, let's say, you want to purchase SpaceX stock, right? Actually having this on a decentralized trading venue where you're not kind of only matched with whitelisted participants or other institutions can actually now enable folks to go down the line down to retail, and then also enable kind of a price discovery of these private markets that have traditionally been held very close to like the company and very close to the investors that are close to the company. So I think that's one. Also potentially using these assets as collateral, right? Being able to generate yield potentially off a private market position, or being able to generate yield off of like a tokenized S&P is something that is unlocked by tokenization as well. So there's some like niche use cases, but I think those are like net new benefits that we can bring to the market.
Yeah, I think one thing that we all take for granted being in crypto is trading 24/7 with real-time prices. And so Superstate, we make mutual funds. And traditionally with a mutual fund, you will have one price per business day, right? And you have to wait until the next business day to get the price of the previous business day to actually exit your position. So to try to solve for this, we came up with what we call continuous pricing for USTB, such that for every second you can get a continuously increasing price of USTB based on what the yield of the treasury bills is. So this allows people to enter and exit positions very, very quickly, and provides more of a real-time price for a asset class that didn't have it. Another use case is that ERC-20s are way easier to send around. So if you are a whale using an OTC desk, you use trading desks regularly, instead of posting USD or USDC as collateral, you could post a T-bill product, which would allow you to, still hold on to some yield without having to give up on that.
Yeah, so some of you already touched upon the element of composability using tokenized assets as collateral. I think that's super powerful. In case you have any other kind of use cases, how we can actually enhance yield or enhance just utility for tokenized assets through the power of composability. I would be curious to hear about that, and also whether we need actually synchronous composability, for example, for flash loans, or if like it's totally fine if it's asynchronous, like sequentially happening for this type of use case specifically. Yeah.
Guess that looks for me. Yeah, so I mean, all of the different components or the primitives in EarnStream, I think we prioritize security and compliance more than anything. And for what we're doing, there's no real need to have like synchronous composability. So asynchronous is probably best for us. I'm sure there's a use case in there somewhere down the line, but asynchronous is kind of where we're at, just because of the regulatory environment. The security and compliance is just where we're at. It's people's wages, it's payroll. And so each of those, I guess, modular blocks of what we're building just really need to happen one on its own. You know, we're trying this out. We don't want to do too much to start. Yeah.
Yeah, so we actually think about this a lot. I was originally under the assumption that everything that we did at Superstate should have a atomic synchronous composability element to it. And I realized that a lot of our customers actually don't care. It's kind of split. So that real-time pricing thing that I was talking about, we built that so we could do atomic subscriptions and redemptions from the fund all on chain. So you wouldn't have to touch anything besides smart contracts. However, we have a lot of customers who, you know, we have some of our customers are venture capitalists investing their funds while they're waiting to deploy them. They don't want to use a smart contract. They want to burn their tokens and then 5 minutes later have USDC sent to their wallet. So it's really the right thing for the right customer. And at Superstate, we do both.
And Jill, you touched upon the regulatory component already. Like, do the other guys have a stance or opinion on what are the regulatory challenges in enabling composability for tokenized assets, like to use them in wider DeFi? Or solutions also, potentially.
Yeah. I think it's been a really tough environment to operate in RWAs, especially for, you know, Plume itself. We're based in the States. We're based in New York. So the core team is, you know, based here. All our engineers and devs are also based in the States. I think traditionally, you know, it's actually been really unclear if you actually tokenize an asset that's not a security and actually and if you put it on chain, the question still stands, does it become a security? So we've been kind of operating in this gray area for a very long time where we don't know actually if tokenizing assets presents additional layer of regulatory risk. Because one of the way that it's offered, you know, on blockchain, you know, can you give this, you know, to the retail folks as well? Does this like classify securities offering? So we're working right now. I think we've actually entered kind of an interesting era with, you know, the regulation in the States with the new administration of, you know, they've classified a lot of, with the lawsuits like Coinbase is offering, you know, Avalanche, Solana securities. I think there is an interesting white space where the admin is currently actually very, very positive on tokenization. You know, at Plume, we've kind of like taken the Uber approach. We're like, you know, if there is no current, you know, guidelines, black and white, we'll operate in that gray area. For example, our focus really is to have assets be distributed even to retail users, right? So, you know, for offerings that are traditionally maybe only given to accredited, you know, we have different ways with protocols that we build in-house. One called Nest, actually Nest DAO LLC actually takes inspiration from the MakerDAO model, where you actually have your own DAO KYBing with different entities, and so they're the entity that that we are facing with issuers, right? And then we can actually permissionlessly distribute yield, similar to how SDAI is actually modeled. So I think, you know, for us, we've always been kind of a few steps ahead on the regulatory side, but more regulation is actually useful for, I think, RDBs in general, because it gives some clear guidelines on how to operate. And so, yeah, I mean, very hopeful. I think a lot of firms, we talked to a lot of institutional firms in the States, a lot of them are very, very bullish and very positive on the outcome of tokenizing these assets. And I think, you know, New York will kind of become, you know, continue to be a hub for RDBs especially.
Yeah, from a regulatory perspective, there were definitely challenges with the old administration. I would say that it actually materially impacted our go-to-market strategy. So our products right now are only for qualified purchasers. Later on this year, our treasury bill fund will be a public fund, so that means anyone who does KYC can invest instead of having to be a qualified purchaser. And like that's just one example of how the regulatory landscape changed, and it actually made our products better.
Cool. Yeah, I mean, some of you also touched upon stablecoins already. We have now, as I mentioned earlier, 220 billion in outstanding supply, and it seems like to a large extent, stablecoins have been the main distribution channel for RWAs since, like, at least for the fiat-backed and like on-chain RWA-backed stablecoins, like it's a really sizable part, or the majority actually of the stablecoin supply that's constructed like this. Like, and do you think that that will continue that way to be that stablecoins will be that distribution channel, maybe also like a compliant liquidity wrapper of sorts, where then everybody can just interact with it, and then as a next step being like the checking account and savings account of the future that people can leverage in a composable way, programmable way through streams and so on and so forth. So how do you see that unfold?
In our case, I mean, stablecoins are obviously the base layer, and so I imagine that the traction only increases for stablecoins. But you know, down the line, there's like we mentioned, like collateralizing future income, being able to get credit off of those products. Like, I can see down the line where the wages being tokenized creates its own like asset class, but I don't think it's going to overtake stablecoins ever, because stablecoins are the base layer of what we're developing.
Yeah, we see the distribution and use case of stablecoins very important for the adoption of RWAs. You know, at Plume, we actually have a neobanking strategy, right? I think what emerging markets have done really well is actually adopted the use of stablecoin as local payment, or like a local way to protect against inflation of their local currency. I think the next iteration, right, is like after you reach this kind of you know, threshold of, okay, now we have we have kind of local economies using stablecoins. How else can they tap into you know, safe ways of yield, or actually U.S. denominated assets that can generate outsized return relative to their local market? So if you can enable, you know, a local investor in Argentina to actually have access to QQQ or Tesla stock, that's a huge unlock for them that I think is overseen, or even a stable savings account, I think is tremendously valuable, because they don't completely trust banks, right? I think there's you know, the benefit of being in the States is actually we trust our regulators and we do actually trust our institutions. But you know, when you go into other emerging economies, that trust isn't always there. And so by having a stable coin, a self-custodial wallet where you can actually earn yield sourced from you know, American capital markets and American you know, products, I think that's a very, very good use case, and something that we're kind of thinking about all the time is, you know, who is like, and also I think there's an aspect of DeFi is kind of tapped out of its marginal user. I think a lot of the folks, you know, who is kind of the next user of Aave or right, these primitives, because they're incredibly difficult to use for the average person. So how do we find ways to expand the pie of distribution and use cases of this over time?
Yeah, I don't think stablecoins are going anywhere especially as long as USD is the world reserve currency. I think what we will see a lot more of, which we're starting to see now, is it's stablecoins in the front, and then it's tokenized products in the back, and those are usually abstracted away from the user. So they're interacting with the stablecoin, they see that they're getting yield on the stablecoin, but the yield is actually coming from, for example, a tokenized T-bill product.
Cool. Yeah, thanks a lot to all the panelists here. Appreciate your thoughts, and we're at the end of the panel. Thanks to everybody here also.